Welcome back, focused learners. Today we're diving into another explainer, and we are tackling one of the absolute biggest debates in personal finance. We're talking about the ultimate magic retirement number. How much money do you genuinely need to reach financial independence, walk away from your day job, and just live life completely on your own terms? Do you need to be a multimillionaire, a decamillionaire? Well, today we're going to break down the actual data and the psychology behind wealth accumulation, drawing on some fantastic financial analysis to separate the myth from the reality.
Okay, let's dive into this. Because if you spend literally any time in the financial community, you've probably heard the relentless fear-mongering. There's this constant message blasting out there that to retire safely, especially if you're living in a high-cost area, you basically need an 8-figure bank account. You hear you need $10 million. No, you need $20 million. But is that actually true? We're going to look at the hard data of what wealthy people actually spend, and we're going to challenge this incredibly widespread myth that you just need to endlessly hoard wealth to feel secure.
Section 1. The Rich Spending Plateau.
Now, what's really interesting here is that to truly understand what it costs to be rich, we kind of have to stop looking at net worth and start looking at actual spending data. Like how much cash is actually leaving the bank accounts of high net worth households every single month. And honestly, this completely shatters our assumptions about how wealthy people live. Let's look at these median monthly burn rates. A household with under $1 million in net worth spends about $9,500 a month. When you jump up to a net worth between $1 and $10 million, it goes up to about $15,000. But here's the kicker. Even when you look at households worth between $10 and $50 million, their spending plateaus right around $25,000 a month. Spending simply does not infinitely scale with wealth. So, why does it plateau? Well, to put it simply, spending an absolute fortune every single day is honestly just exhausting. As our source material humorously points out, unless you're out at the club throwing bills around every single night, it's remarkably hard to actually spend more than 30 grand a month. If you're dropping $1,000 every single day, eventually you just get tired of crazy expensive restaurants. Eventually, you just want to be a homebody. Grab a burrito at Chipotle and sit on your couch to watch a free Netflix show. You literally just run out of reasonable things to buy. Beyond just wanting a quiet night in, there are actual structural reasons why spending hits a ceiling. First off, massive net worths are often tied up in illiquid assets. A business or private equity might look like $30 million on paper, but that's often just a vanity metric. You can't spend an unsellable brand at the grocery store. Second, you eventually just buy everything you need. You buy the house, you furnish it, you take the big trips, you make the upgrades. After a certain point, going from $20 million to $21 million doesn't change your lifestyle one bit. Your focus just shifts to watching percentages tick up on a screen rather than spending absolute dollars. Section 2. Money as a scorecard. And this brilliantly illustrates the psychology at play here. Because if the data proves that people essentially run out of things to buy around $25,000 a month, why does the financial community keep pushing people to amass these larger and larger portfolios? Well, it comes down to psychology. There is a massive difference between treating money as utility, using it as a tool to buy a house, afford healthcare, take trips, versus treating money as a scorecard. For a lot of people, especially highly driven individuals, dollars simply become trophies. It's like counting calories or tracking how heavy you can lift at the gym. Hitting $10 million is just leveling up. The pursuit becomes entirely detached from what the money can actually buy, turning into a never-ending and ultimately unhealthy game of keeping score. Section 3. The $4 million massive. All right, let's step away from the scorecard mentality for a second and get back to utility. If $25,000 a month is the absolute ceiling for an incredibly comfortable high-end lifestyle, exactly how much do you need in the bank to generate that? Let's work backward through an intentionally aggressive example. To spend $25,000 a month, you need $300,000 of after-tax income a year. Assuming a pretty conservative 35% tax rate, you'd need a gross income of about $460,000. Now, if we subtract a reasonable expectation of $72,000 from Social Security for a married couple, your portfolio needs to generate about $388,000 per year. And by the way, because of how capital gains and cost basis work, your actual taxes would likely be much lower than this, which gives you an even bigger buffer. So the crucial point is, to safely withdraw that kind of money using a standard 4.7% withdrawal rate, you need a portfolio of about $4 million. Okay, but how do you actually get $4 million? It's not magic. The math shows that if you are 20 years old and you consistently invest just $750 a month into a broad market index fund, averaging an 8% return, you will have $4 million by age 65. $750 a month. That is a concrete, entirely achievable target grounded in real-world data, not some fantasy number pulled out of thin air.
Section 4. Early retirement and risk.
But what if you don't want to wait until age 65, right? What if you want to retire a decade early? Well, this introduces a massive debate among financial analysts regarding risk and withdrawal strategies. When you retire early, you are battling something called sequence of returns risk. This is the terrifying possibility that right after you quit your job, the stock market crashes. If you're withdrawing heavily from a shrinking portfolio, you might permanently deplete your wealth and never actually recover, suffering what is known in the industry as a lost decade in the market. And this creates two very different schools of thought analyzed in our sources. On one side, financial analysts like Aaron argue that if you're just trying to bridge a 10-year gap until Social Security kicks in, an 8 to 10% withdrawal rate, say 9%, is perfectly reasonable because it's a short time horizon. But on the other side, conservative analysts like Graham Stephan strongly disagree. They argue that taking almost 1/10 of your portfolio out every single year is incredibly risky, because if the market dips, a 9% withdrawal could wipe you out entirely. So Graham argues for a strict maximum of 5 to 6% just to guarantee survival.
And that conservative caution isn't just about stock market dips. There are massive, completely unpredictable retirement disruptors out there. What if you face a major health emergency in your later years? What if the Social Security system hits a crisis and benefits are cut, or taxes are hiked to pay for it? The sources even point out potential wildcard scenarios, like AI and robotics completely disrupting the global economy or the value of the dollar. These are the giant unknowns that keep conservative investors awake at night.
Section 5. 5 versus 10 million. Let's move to the ultimate showdown and see how this all builds together. When we balance the actual spending data with the very real risks of the future, what is the final verdict? Is it $5 million or $10 million? Well, the reality, grounded purely in data, is that $4 to $5 million is genuinely enough to cover the highest realistic spending levels of an extremely comfortable life. However, $10 million is what buys you true psychological peace of mind. At $10 million, you have an extreme margin of error. The market could drop 50%, AI could disrupt the economy, you could live in a super expensive area like San Francisco and New York, and you wouldn't even flinch. Basically, $5 million is the practical number, $10 million is the absolute bulletproof vest.
So, what should we actually take away from this explainer? It's time to redefine your financial goals with 3 simple, actionable steps straight from our sources. First, stop picking random, gigantic numbers out of thin air just to satisfy an ego. Second, actually sit down and write out your loftiest, highest ideal monthly spending. We're talking thriving, not just surviving. And third, work backward from that specific amount. You might actually find that your most ambitious version of financial freedom is entirely feasible, way sooner than you thought. I want to leave you with this final, provocative question. What is your loftiest ideal spending? Don't let money just be a scorecard. Run your own numbers, map out your own dream life, and you might just realize you don't need to chase endless wealth forever. Thank you so much for joining me on this explainer. Keep learning, keep planning, and I'll catch you in the next one.